Today, I wanted to look at this capital budgeting again, and I just wanted to kind of make sure that any of you missed it. I'm going to go through a quick review here, okay? Just in case anyone missed it. So what we've got with this capital budgeting is really a bunch of little subjects that are all kind of thrown in together, but effectively they all are decision-making tools. As a manager, you're going to be tasked with the idea of spending someone else's money, be it a company's money, a town's money, anything else. So you're tasked with spending other people's money.
I always did like spending other people's money.
Yeah, I know it's a terrible thing. I kind of like it too, but on the other hand, it comes with a share of weight, right? As we prepare the town budget, it comes with a share of weight. The fact of the matter is, when you get ready to spend someone else's money, you want to be able to make the wisest possible decision on where to spend that money, or whether or not you should or shouldn't spend that money, all right? So capital budgeting is all about that. It is about making decisions with regards to complete a project, buy something, not buy something, rent something versus buy something, these types of scenarios. I've broken this section into a series of topics. And the very first one deals with capital budgeting, which is really net present value calculation. It says, let's look at the time value of money in order to help us make a decision with regards to money that flows over a period of time. Okay, so let's say we have a project that costs us a good chunk of money up front, but it's going to pay money into the future. And effectively, what we need to do is to compare the amount of money we're putting up front versus the value of, or the net present value, in other words, the present value now, today, of that stream of money that we're going to get. And what we're going to do is compare how much money we put up front versus the value of the stream over time, and ask ourselves, is this worth pursuing? That's the simple crux of it, is we want to be able to do that. So do we do it or do we not do it is really the point. I showed this little video here. I had a simple little scenario where you have a town who's trying to buy a tractor or thinking about buying a tractor. It has an outlay up front, and then it has several years of value that comes from the tractor in terms of work done. And we're going to compare the upfront payment versus the net present value of the stream. So you can, I've already showed it, but I'm not going to show it again today, but you can see that, that process. And in order to make this process work, what we do is we look at the stream of payments that's coming from it, from the given project, and we bring the value of the stream back to present day. Now, the stream could be a steady stream of money. So it could be like every year we get $5,000, okay? Or it could be a situation where every year we get a different amount of money, say $3,000 next year, $6,000 the year after, and so on. Depending on the type of situation that we have, whether it's a stream of money, constant stream, or whether it's a series of positive amounts, we got to be able to count to figure out the net present value. Well, for a stream, we can do the net present value of an annuity if it's a stream of constant dollars. So we just use the annuity formula, calculate the present value of an annuity, and that will bring that back, and we compare it against how much we invested. If it's not a steady value of money, we can use the present value formula and do a present value calculation on all of the items. So this particular one that I have right here in front of you now, the example 61A, looks at the scenario where we've got differing amounts of money coming in over the course of a period of time. So we got a 4-year investment, promises to pay $3,000, $6,000, $5,000 at the end of the first, second, and fourth years, respectively. A cash injection of $1,000 is required at the end of the third year. The investment may be purchased for $11,000. So effectively, we got a whole bunch of numbers being thrown at us, okay? What we need to do is allocate those numbers in time. So $11,000 we got to put up right now. That's now. The $3,000 is going to come in the first year. So we got to discount that back 1 year. The $6,000 is going to come in 2 years. So we got to discount that $6,000 back 2 years. The $5,000 is going to come in 4 years. So we got to discount that back 4 years. And the cash injection of 1,000 is required at the end of the third year. We got to discount that back 3 years. So we got pluses and minuses of money. Money that's coming in, pluses, and money that's going out, minuses. We take the present value of all of those, which is what we're doing here at the given discount rate. So the rate in this particular example is 5%. So we take 3,001 over 5, which gives us the present value of 2,857. Take 6,000, 1.05 to the power of 2, and that we get the present value of that at 5,442. The $1,000 that we got to put out, we're doing the present value of that. So that's you notice it's a negative. That's money flowing out. That's in 3 years' time. So we're taking the present value of that, 864. The 5,000 is coming in 4 years' time. So we take the present value of that. That's 4,114. We add those together, and that's $11,549 net positive. Well, we got to pay $11,000 up front. So that kind of comes off that. So really, we're $549 to the good. So if we ask ourselves, should we or should we not? If we're $549 to the good, yeah, let's do it. So that's kind of how that works. And I got a second example there. Works on the same basic thing. The rates, the rate of money, the value of money or the rate of return is going to have a significant impact on whether or not we accept or reject the investment. Okay. So I things up on a kind of I use a graph paper kind of thing. And effectively what I do is I take the net present value on the left-hand side and I just bring everything back to that. So the timeline goes along the top right, and I just kind of write my amounts along there. I take the present value and I bring the present value and put in that column there on the left. Negative numbers would represent money going out. Positive numbers would represent money coming in. You add them all up and you get the sum of the value at the end there. And if it's positive, great. If it's negative, let's not bother doing it. Looked at in the video, I did Van Camp in the video. I did that example and that was good. In the I don't think this one's on the video, is the timber rights of attractive forest. Okay. I believe I'm right in saying that's not on the video. What I'd like us to do is to take a few minutes and to do number 4. Okay. So I just wanted to talk through it first before we do it. Looking at number 4, it says the timber rights to a tract of forest can be purchased for $250,000. So that means we got to put $250,000 out now. The harvesting agreement would allow 25% of the timber to be cut in first, second, fourth, and fifth year. The purchaser of the timber rights will be required to replant at their expense in year 3 and 6. Okay, so we got 6 years of total activity going on here. Arrowsmith Lumber calculates that its profits in the 4 cutting years would be $90,000 a year. And the cost of planting would be $30,000 a year. So what we have to do here is to get the net present value of all those sum amounts. And the net present value, which I don't have put in yet. So if we use this little table I got here, this little dynamic table, what I'm going to do is I'm going to put year 1, year 2, year 3, year 4, year 5, year 6 across the top. The initial outflow of that was $250,000. So I'm going to put minus $250,000 right here. And then for years 1, 2, 4, and 5, I'm going to put how much money came in. So 90,000 in year 1, 90,000 in year 2, 90,000 in year 4, and 90,000 in year 5. So basically, I'm going to line that up. And then money going out was in year 3, it was 30,000 going out. So year 3 is over here, 30,000 going out, and year 6, 30,000 going out. So I want you to kind of take a few minutes to set that problem up. And while you're doing that, I'm going to see if I can add in my solution set. I'm going to go to the problem. I'll keep that up there. I'm more interested in the setup as opposed to the calculation. Okay, I think I've given enough time. You probably don't have to finish, but in the meantime, just let me just show you this here. Okay, so hopefully I think you can see this.
Yeah.
You can see it?
Yeah.
Okay. So what we got is in the first year, 90,000, second year, 90,000, fourth year, 90,000, fifth year, 90,000. That should be 90. So I've just put the years across here and the present value is down here. So 250,000 right away is spent. That in order to get in the ball game here, you got to spend 250,000. 90,000 is going to come in the first year. So we take 1.055. Where'd the 055 come from? The cost of capital is 5.5%. That's 0.055. And 1 plus 0.055 to the power of 1 is, well, the formula is, so 1.055 to the power of 1. That comes to, the present value of that is 85,308. Year 2, there was another $90,000 that came in. It is 1.055 to the power of 2, seems 2 years. This then equates to the present value of $80,860. In the third year, that was a replant year, so 30,000 had to be spent. So we take 30,000 divided by 1.055 to the power of 3, since 3 years. That's a negative 25,548.41. In the fourth year, there was another 90,000 come in, so we take the 90,000, 1.055 to the 4, and that's equivalent to 72,649.51. In the fifth year, another 90,000, that's 1.055 to the power of 5. That's 68,862. And then in the final year, there was a 30,000 planting. So we take that 1.055 to the power of 6. And that comes to 21,757. I then proceeded to add up all of these numbers to pluses and minuses accordingly. And I got 10,374.59 positive. So this indicates we're using this as a decision-making tool, so the exact number doesn't matter, okay? You don't worry about decimal places. In fact, you could round these to the tens of dollars. It doesn't matter. What we're trying to do is, does this make money or does it not make money? That's the basic question that's being asked. So I calculate that we're 10,000 and change to the good. So thinking about this project pays us money. This is worth doing because there's benefit in it at 5.5% cost of capital. So we should move ahead with the project. And if we're asked, well, how much do we expect? Well, we expect $10,374. Do you see that?
Yeah.
In question 5, then, question 5, it says repeat. Repeat problem 4, but change the cost of capital to 7%. Okay, so I just changed it to 7%. Now, again, what I've done in question 5 is I've done the same thing here again. Number 5, 250,000 has to be put out for the purchase. 90, 90 minus 30, 90, 90 minus 30, 7% cost of capital, which is 0.07. We do the exact same thing here. 90 in, 90 in, 30 out, 90 in, 90 in, 30 out. We take the present value of them. We add up that, and even though I can't see it because that thing is there in the way, I think it's to the positive, if I recall. Yep, it's 1,600 or 1,161 to the positive. Now, it's still to the positive, so we will still move ahead with the project. We will still buy the timber rights. But obviously, with the higher interest rate, the return just isn't there as strong as it was before. So we might want to ask ourselves, is this worth doing? Or do we have an option that's better? Okay, so instead of a raw decision, the raw decision is, yeah, let's go. But we need to consider too, is there another project that potentially is better? Okay. But this is how this type of net present value calculation works. All we're doing is we have a string of flows of dollars, and we are looking to assess them, compare apples with apples, all in that first year. The lease problem is almost identical, okay, in terms of how that works. It's only when we talk about a lease, we're talking about a constant flow. So this is an annuity. When we decide between leasing and buying capital assets, one of the considerations has to be which option will cost less in today's dollars. So before we value a lease, let's look some of the lease terminology. So we got to think about the lease amount, which is the present value of the assets being leased. And we need to look at something called the residual value, which is how much we'll get back at the end in one way or another. Usually, in a lease, there may not be any residual value, but in a purchase, there is. So we can calculate our lease payment. It's usually given it to us. And we use this present value of lease formula, which is just a present value formula for a annuity. And where lease payments are made at the beginning of the period, it's an annuity due, hence that 1 plus I. So in this particular example right here, we looked at number 7 the other day. We looked at number 7. A machine can be leased for 4 years at $1,000 per month at the beginning of each month. So that, by definition, is an annuity due, and it's monthly payments for 4 years. So we got 4 years times 12. 4 times 12 is 48 periods. So N is 48. Alternatively, it can be purchased for $45,000 now and sold for $5,000 after 4 years. So the residual value is $5,000. So what we're looking at here is 2 separate calculations. First, for the present value of the lease payments, and second, for the present value of the purchase. And then it says, okay, we got different rates, compounded monthly 6.6% or 9% compounded monthly. Now, we did take a look at that one in the process. And just let me see if I can find it here. Okay, so we looked at that one the other day in terms of the video, and it showed how to do that. And I'll just go to, I gotta go to the video. I thought I had it written down and I don't. So I need to, here's time as good as with the buy is we're calculating the present value. So in this particular problem then, I'll just run through this again. This is just a few minutes. What we need to do with the buy is we're calculating the present value of the buy. So let's look first of all at the lease, the present value of the lease. So anyway, let's read number 9 and number 7. A machine can be leased for 4 years at $1,000 per month, payable at the beginning of each month. So the beginning of each month is the clue that this is an annuity due. Alternatively, it can be purchased for $45,000 and sold for $5,000 after 4 years, should the machine be purchased or leased. So assuming first we're looking at a 6.6% rate of return, okay? So let's do this. So some basic facts of the matter is we're spending $1,000 a month on the lease. It's made at the beginning of the month, so it's a due. We got 6.6%, and that is compounded monthly. So we've got some key figures there in terms of the lease. So let's just work that out first. So, and it's for 4 years. Okay, that's it. Maybe we should mention. So that's a total of 48. Let me bring it up. Oops, sorry. Mistake. In terms
Paul? Paul?
That's really all we're dealing with here. Have you got you back? Because I had you lost.
Yeah, I was gone for a second. I don't know what happened. I thought it was my internet.
What happened?
I don't know. The video just froze up. I tried to reach out to you, and I got no answer.
No, because I was kicked off too.
Oh, okay.
I don't know. It says it's back now, but the machine would send me a message, but I was unlocked from the system.
Okay.
Sorry about that. So what we're doing here, what I'm trying to show you.
It's gone again.
Doesn't like that part of the video.
Paul, you there? Can anyone hear me, or?
I can hear
I don't
you.
know what's happening, but it seems like our meeting we're losing our feed. I don't know why.
Don't like that last part of the video.
No. Ooh. Okay. Okay. So I showed you that video the other day on how to do this, and effectively the crux of it is from the lease you need to be able to do a payments. You need to be able to calculate the present value of the payments using an annuity due. Okay. Now, so using the present value formula, we draw the information, we bring it back, and we ask ourselves, what is the present value of the lease? And then we got to bring back the payments, and we're looking for the present value of the payments. Now, I'm going to try this one more time. I'm going to speed it up in the interest of time because I'm afraid that might be what's causing the system to break down for today. That's the first time that has ever happened. Which is really weird. No, our system is crashing today. I don't know why our system is crashing. Anyway, let me just stop me here because I think that I'm the one that's causing the problems here. Stop. Okay. So what I'd like to do today is using this same type of methodology. I wanted to go through one more example here. Now, where is my example? Bear with me. I'm confused now where I am because I lost my focus. Okay, here we go. Lease versus buy. So we looked at number 7 there in the video, and if you don't understand this, probably it's best you have as equal access to the video as I do to show how this number 7 is calculated. But number 8 is basically the same type of problem. So today I would like us to try number 8. So if we get cut off, I'm busy working at number 8. Number 8 says a real estate salesperson can lease an automobile for 5 years at $5,000 a month, payable at the beginning of each month. So this is an annuity due. We know that, 500 a month, 5 years, that's 60 months in total, an annuity due. Or you can purchase it for $32,000. She can obtain a loan at 3.75%, compound it monthly to purchase the car. So should she lease or buy a car? Now, there was a couple scenarios. Let's look at the first one. Trading value of $5,000 after 5 years. So it's a 5-year lease. The very first thing we need to do is look at what is the present value of the lease. So using this key information, $500 a month for 60 months in total, 3.75 is the monthly compounded rate. We need to figure out what 3.75 is per month. So we need to take 3.75% divided by 12 in order to get the monthly rate. We're going to plug all that into the present value formula, which is PMT, the present value formula. And I've got it up here, right there, that formula right there. We're going to plug that into that formula. Whoops. We're going to plug that into that formula, and that's going to give us the net present value of the lease. Okay? That's going to be option 1. Yep.
I can't see anything up on my screen.
Don't tell me that.
Yeah.
Nothing.
It's just your little face icon. That's it.
That's it, eh? Gee
Yeah.
whiz. Trouble. Let me try that again. Is this working?
Yeah, now you got it.
Yep.
Yeah, I got it. Yeah. I'm getting kicked out of everything here today. Okay. Let me just say this again. Start over again. 8 was what I want to look at. So I got a real estate salesperson. She got a lease buy option. She can buy the car. She can lease the car. She's looking for the least cost option. Okay. In order to figure out the least cost option, what we need to be able to do is take the lease amount, first of all, and figure out what the net present value of the lease amount is. Well, it's $500 a month for 60 months, 3.75% compounded monthly. So we need to get the monthly interest rate on that. We need to throw all that information into the present value formula. Okay, so the present value formula is located, I put it right here. It's a little bit fuzzy, but I put it right here. It is an annuity due, so we got to multiply it by 1 plus I. So that's going to give us, when we do that, that will give us the present value of the string of lease payments. That's the first thing we need to do. The second thing we need to do is to say, okay, what is the present value of the purchase of the car? Okay, well, it's $32,000 now, so that's the present value of the now amount. But it does say at the end of the car's life, or we're going to sell that car, and we're going to get $5,000 for it at the end of 5 years. So we got to get the present value of that $5,000 and bring it back to today and subtract that off the $32,000 car. So I wanted to give you 10 minutes now to see if you can do that problem. Part A, we'll look at part A only. Okay? Now, just so I can judge time on this, I'm going to do it myself here. How's everyone making out?
Good.
Just going to put up the sheet now as soon as my computer comes along for me. Again, we keep in mind what we're trying to do here. We're not trying to get an exact answer. We're trying to make a decision. So So we've got a situation here that we're looking at a lease and we're looking at a purchase. So first the lease, which is the more complicated calculation. We're doing 60 months, $500 a month, 3.75%. We got to calculate the monthly rate of interest. So I is 0.0010033125. We'll plug all that into the formula and we get $27,401.92. So that's the lease cost. Okay. L-E-A-S-E, not leased, L-E-A-S-E, the lease cost. The total present value of the lease is $27,401.92. Over in the little box on the left, I say, well, the payment. So it's $32,000 we got to pay. And we're getting the $5,000 back at the end when we sell the car. So let's take the present value of $5,000, which is at that interest rate is 4,922.71. We take the 4,922, subtract it, or take it off the 32,000. So the car to buy is really costing us $27,077 outlay. So we've got really two potential outlays. We can buy it for 27 and change, or we can lease it for 27 and a half or 27.4. So we're asking ourselves, which option would we choose? Well, we're going to take the least cost option. So the least cost option is buying it. See how that works?
Yep.
Nope.
No?
No, that didn't work out for me.
Okay. Well, I want, so using this as the model then, so do you understand what I did?
Yeah, the first part of it I got okay, the 27,400, but it's the purchase, the second
Okay, the
part.
purchase. Okay,
Yeah.
so what we got is $32,000 needs to be outlaid right now. We need to plunk down $32,000 now.
Mhm.
with the promise of $5,000 in 5 years. When we sell the car, we'll get $5,000 back for it. So what we need to do is figure out what is the present value of that $5,000.
Yeah.
So the present value of that $5,000 at that stated interest rate of 3.75 per. Oh, I think I made a mistake.
So it should have been 4146, right?
I neglected to think about the payments. Number of payments. I put in 5 years of payments. That should have been 60. Mistake. Yep. 60. So I need to do my math again on that now.
Do you have the workings that you did on the screen or no?
Did I have the workings that I did on the screen? What do you mean?
Did you post it on the screen? Because right now I only see the question.
I'm getting kicked out. Why am I getting kicked out? Yes, I did. Sorry.
I don't see it. Yeah. There.
Sorry. I'm getting. I'm having computer problems here today. Here we go. Okay. So there it is right there. But I neglected to think of the 60.
Yeah.
So I made a little boo-boo there. I need to do the math on that again now. So I'm just punching numbers into my calculator here. If you're wondering what in the frig is he doing? 1.00. Says 1.2058. So that's 4,146.62 is what I got.
Yep.
And that nets out to 27,853. I'll correct that now when I get a chance. So we got 27,000. The purchase, yes, the purchase is 27,853. The lease is 27,401. So we should pick the lease. We picked the least cost option. I'll tidy it up. Okay.
Perfect.
You see how that works?
Yeah.
The math is a bit of a pain, but the mechanics of it are pretty straightforward. Okay, so that's those. So that's what we looked at there, and I'll revise that now in a couple minutes. In terms of the last few things, and this is just what I call the more trivial matters here, is there's a terminology called the hurdle rate, which is the hurdle rate is really the rate of interest that makes the project. It's like a break-even point. It's the point at which the project becomes feasible or not feasible. Okay, so that's just the terminology, that is. To invest or not to invest, and as I say, there's what we just did. And I got a couple more problems there, and this is St. Lawrence Bus Lines is number 1, and that's what I'd like you to take a look at next. Now, all of these are of a similar type of situation, okay? What we're doing is we need to calculate the present value of the stream of payments. So in the case of St. Lawrence Bus Lines, is offered a contract for busing school children. Let me boost that up so I can read it. That will produce an annual profit of $70,000 for 7 years. So they can make $70,000 for 7 years. To fulfill the contract, St. Lawrence is going to have to go buy some buses. So it has to go out and buy $433,000 worth of buses. And at the end of the contract, they're going to get $80,000 back when they sell the buses, okay? So this is almost an identical problem to the one we just did. We have money coming in. And the money coming in is $70,000 for 7 years. So we need to find out what the present value is of that $70,000 for 7 years. So that's the present value in an annuity. We also have money going out. So right off the bat, we got to put $433,000 down. So that's money going out right now, $433,000. But at the end of the contract, we're going to sell those buses and we're going to get $80,000. So we need to discount back the $80,000 that we paid for the bus that we're going to get for the buses. So we need to find out what the present value of $80,000 is and subtract that from the cost of the initial purchase of buses, which is $433,000. And we're going to use a cost capital of 6, 7, and 8%. Well, first of all, I'd like to do it for 6%. Okay. So what I'd like you to do now is, again, this uses the same mechanicals that we just used in that problem. We need to think about a present value of a payment. So this is $70,000 for 7 years. So do the math on that, and then draw back that $80,000 to now. So take a few minutes to look at that one. So if we look at this one here, again, we've got a similar type of situation that we need to consider. We've got $70,000 coming in for 7 years. Okay, so the very first thing that we really need to do is to drop this type
Showing workings are not great.
here. Right off the bat, we got to put 433,000 down. So that's negative 433,000 over there in that now category. Then we need to think about what is the present value of the stream of revenue. So it's 70 for 7 years. We put that into over here. I've got the formula kind of squeezed in there. So basically I did the present value formula of the string of payments, $70,000, 6% comes to 397.66. So that's the net present value of the stream of payments is 390,776 or 766. So that means that that's how much money comes in from this part of the enterprise. And then the third element is at the end of it, there's $80,000 when we sell the buses. We're getting $80,000, and that's in 7 years' time. So that's a payment in 7 years. So we got to get the present value of $80,000 in 7 years' time at 6% interest rate, and that's $53,205. So that is added back on to our positive flow. So we'll take the 433 that we spent, add back the 390 that we made, add back the 53 that we made, and that comes up with a positive number, i.e. $10,972.34. That means that we're making more coming in than money going out. So at 6%, we're making $11,000 on this contract, or approximately $11,000 in this contract. So we should proceed with the contract. You see how that works?
I think so, yeah.
Do I still have a connection? Hello?
Yep.
Hello?
Any questions with that?
Griffin is coming in, but I'm not sure what he's saying.
Oh, I think my internet's being garbage again. Oh boy.
I can hear him fine.
I take it that I still have you connected. I can see that it's working. It looks like it's working. Any questions on that? Hello?
I'm here.
Is there anybody out there?
You don't hear us?
Is there anybody on there in the system? Is it working?
Yeah, hello.
No,
You
I
hear us?
can't hear you. No. So Griffin has texted me to say that. Okay. So check. Okay, you're here. I got some written messages, so that's good. I'm all set then. Okay, did you see how I calculated that? Generally?
Yeah.
Okay. So that's all of these are about the same sort of thing and how they're done. I just wanted to introduce you to this last. This is really the. There's a couple little, I'll call them throwaways that we put in here. Something called capital rationing. Okay, and this is a pretty straightforward thing. Capital rationing occurs when we have when we're a company and we only have so much money to spend. It's economics, right? We only have so much money to spend, so we've got a choice of multiple number of projects. Okay, so we're looking at our year ahead and we're saying, okay, we got all these projects. We got 3 or 4 projects that we could do. They're all coming back with net present values like we've just calculated. They're all coming back with positive, but we only have so much money. We can't do everything, so we have to make some choice. So businesses need to constantly consider what is the best possible project to pursue. Okay, So capital rationing really involves picking out the ones that make the most sense to do. That's all it is. What are the best projects? So we're going to pick the ones that yield the highest rate of return. So what do we need to do in order to do this? Well, basically we look at it. That's as simple as that. We calculate the net present value as we've just done in those examples. We're calculating net present value per dollar spent on every project. And we simply rank the projects on the highest value to dollar spent. Okay, so how does that work? Well, we need to look at an example, and I believe number 1 here. And I'm going to go down here. I'm going to try this one more time now in order to okay, just a second now. Project A, we only have so much money. We can only... Okay, so here's capital rationing. So again, we're looking at, in this one, I want us to look at number 1. Example number 1. So I'll just bring this up now. A firm has identified the following 4 investment opportunities and calculated their net present values. In other words, they just did all the work that we just did on the projects, like we just looked at several of those projects. If the firm's capital budget for this period is limited to $300,000, which project should be selected? So we've got project A has an initial investment of $100,000, and it's going to yield a net present value of $25,000. Project B has an initial investment of $60,000, and it's going to yield a net present value of $40,000. Now, just keeping it simple, looking at the first 2, we spend 100, we get 25. We spend 60, we get 40. It would make more sense to do the 60 and get the 40 than it would to do the 100 to get 25, right? This is how much money we're getting back out of it. This is how much money we got to put into it. In C, we're investing 130, we're getting 60 back. And in D, we're investing 200 and we're getting 100,000 back. So we only have $300,000. So if we add all these up, we can't do them all. 100, it's 200, 130, 60, and 100, which is way above $300,000. So we got to be able to pick the winners. So how are we going to do that? Okay, so effectively, we're asking capital rationing, which project should we do? Well, the net thing is, we know how much we're putting in, and we know how much we're getting back. So if we compare what we put in to what we get out, in, out, in, out, in, out, in, out, we can take a percentage. So, for example, 100,000 in, 25,000 out. That's a 25%. 60 to 40. Well, that's more like a 70%, 67%, and so on. So we can find the ones that have the highest rates of return. I'll go down to the video now and explain it in that. Notes here. Excellent. I got to get rid of this. That little thing gets more. Okay. Okay. So in set 16.3, question 1, we see a good example of capital rationing. A firm has identified the following 4 investment opportunities and calculated their net present values. If the firm's capital budget for the period is limited to $300,000, what project should be selected? So we have $300,000 to spend. That's effectively what we got, or I should use the word invest as opposed to spend. So we have $300,000 to invest. And the question is, what projects can we do? Okay, well, the problem gives us some issues here. It gives us project A, B, C, and D. And project A, the upfront cost of project A is $100,000. Okay, $100,000. For project B, it's $60,000. For project C, it's $130,000. And for project D, it's $200,000. Now, if we just looked at it at that, you know, we'd say to ourselves, wow, we got $300 to spend, $300,000 to spend. We could do either one of those projects, certainly. The question is, which one should we do? You know, should we do this one and this one because we have enough money? Should we do this one and this one? Well, how do we make the choice of which ones we can do? Well, the upfront cost is not sufficient for us. What we also have to do is to consider as well what we something called the net present value. And we've seen in our calculations of net present value is considering how long the project is and these sorts of things. With the time value of money, we take it back to say, how much is the total value of that project when you consider profitability? Like, how much of that? So net present value reflects the current true cost of that in terms of real dollars. So net present value for the first project is $25,000. For the second project is $40,000. Third project is $60,000, and the fourth project is $110,000. Okay, so again, looking at net present value, that's not much good in terms of figuring out how much we can spend, because these numbers are not reflective of the actual. This is how much is actually worth. So what we have to do really is to look at the comparison of the net present value relative to the upfront cost. So if we were to take the net present value per dollar spent, this is the calculation we need to make, is we take, for example, $25,000 net present value divided by $100,000 we have to put up in front, and we get 0.25. If we were to take the net present value of the second investment, is $40,000, plus divided by the $60,000 up front, that's 0.67. And if we were to take the net present value of the third project, it's $60,000 divided by the initial investment, which is $130,000, and that's 0.46. And then the fourth project, we're looking at it's $110,000 net present value compared to the initial cost of $200,000, and that's 0.55. Now with that, we can rate which ones give us the best ratio of value to money spent. So let's rank them. 0.67 is the highest one. This is a number one project. That's the highest. In other words, the net present value is the highest per dollar spent. The next one is project D, which has 0.55. So that's the second major project that we could do. The next one is project C, and finally the lowest one is project A. So this is the order in which we should attack the projects. Now the question is, we only have $300,000 to spend. So project one, project choice one, is B. So project B is $60,000 up front. So that means we have left over. It's 300,000 is how much the budget is minus the amount, 60. So that means we have 240,000 left over to work on another project. Well, our second rated project then is project D. D, it's the second highest. It has an upfront cost of $200,000. So the amount of money that we have left over after spending that is $40,000. So can we do anything else? Is there any upfront cost that's less than $40,000? No. So project B and D would yield the biggest bang for the bucks that we're spending. We're not spending all of our bucks, granted, but it certainly provides the best bang for the buck. And that's what project rationing is supposed to do. It's supposed to tell us, hey, here are the projects you should pick. And in this case, B and D are the best projects. That's a pretty simple concept. All we're doing is looking at how much do we put in, how much do we get out, what's the ratio, and we pick the highest ratio. So that's pretty standard for that capital budgeting to be able to do something like that. Any questions on that?
No.
I think that you know, if we look at number 2 here, just let me bring that up. So I think we can do this together. An investment committee of a company has identified the following 7 projects with net present values. If the board of directors has approved $3 million capital budget for the current period, what projects should be selected? So as we've seen, we have an initial investment amount and we have a net present value. The initial investment is what you put into it. The net present value is what you're going to get out of it. So if we were to take 1 million going in, 600,000 coming out, that's a 60%. Okay, so that would be 60%. I've run out of paper. I want you to just take a look, just do the numbers on for number 2. Do the numbers and figure out which ones have the highest percentages. So if we look at this one, effectively you got to do the same thing. You're just taking the project and you're comparing the investment against the net present value. Okay. So the net present value versus investment for project number 1 is 0.60 and right down through 0.18, 0.38, 0.45, and so on. So we do the math on that and then we just rank them. So number 1 comes in as project choice number 1, project number 4 is choice number 2, and so on. So we do that. So effectively we rank the projects. We know that our budget is $300 or $3 million. That's our budget. So that's the most we can spend. So we just pull the projects out that are the most beneficial. So number 1 is $1 million investments. Okay. The number 4 is the next one, and it's a $600,000 investment. So we're up to $1,600,000. Number 3 is a $750,000 investment. We're up to $202,000,003. Number 5 is a $450,000. We're up to $2,000,008. And we can't do number 2, which is the next one in the rank, but we can do number 6, which we have enough money for. So we can basically draw down $2.95 million and do 5 of the projects. And you know, this is a very similar system that in order to evaluate roads. It doesn't use net present value. It uses the condition of the road, but effectively this type of ranking system is done. And you can make decisions with regards to project choices based on that analysis. Any questions there?
Nope.
Okay, well, that pretty well covers what I wanted to do today. That's enough for today. I don't want to overdo too much. On Wednesday, I'll look at the topic 3. And again, these are very brief topics. Topic 3 and topic 4, which is comparing investment options and the payback period. So we'll look at those then. Thanks for bearing with me in some of the troubles today. I don't know what's wrong with the internet, but anyway, sometimes it's a little funky.
Jacob and Joel, please.
Hello. Hi, guys.
I got my kids home. Can't you tell?
Yeah, that's all right. That's good. That's good. Been there, done that. Been
Yeah.
there, done that.
It's wicked.
Anyway, you have a fantastic day with your kids.
Take care.
Yeah.
It's homework time for them now. Yay.
Yay, good job. Okay. See y'all.
Bye.